Welcome to today's webinar on how to help your kids get into the housing market. So I want you to think about your own home for a second. What would your kids need to buy that house today? Well, realistically, probably a higher down payment, more income to qualify, stable income, and better credit. So here's the second house I ever bought. So it cost me $20,097 for down payment for this house. Um, we bought it in 2008 for $401,932. Um, our mortgage interest rate was 4.99 at the time. And what I really want you to look at is this increase in net worth. So this is different values of what this home was worth, right? So it was worth $100,000 more 2 years after we bought it. Think about how much overtime your kids would have to work in order to make that kind of money. Or 5 years after we bought it, it was worth $261,000 more. And 12 years after we bought it, it was worth $659,000 more. If my kids wanted to buy that house today, they would need a minimum of $240,000 down payment. That's a minimum. That is much more than the $20,000 I needed. They would need $192,000 of income to qualify to pass the stress test if they had zero debts, right? No car payments, no student loans, anything. And it's also worth noting that at the time, we could use $1,500 a month from the illegal basement apartment to help us qualify with the bank. And typically, most lenders require that to be a legal basement apartment these days. Um, and the really big kicker is that that was our second home. So we could actually refinance our first house to 95% of the value to pull out that down payment to buy that one, right? You can't do that today. So can we all agree housing market's getting a little worse? Not ideal. So there is a lot of reasons why we would want to help our kids get into the market. Who are we? So experienced mortgage brokers with hundreds of happy clients that can attest to our service, our knowledge, advice. We've also won a lot of industry awards just to show you that we're really good at what we do. I have 3 kids and I think about protecting them and getting them into the market all the time. There's a bunch more coming up here. There we go. This is just a note. This is not based on any particular lender guidelines. So we work with 59 different lenders. We have a host of different products. They can all do something a little bit different. So it's just worth knowing that we don't just work with one lender. And if that lender doesn't like the types of products that we're talking about today, that is not a fit. There's lots of options out there for you. So 2 things we're going to address here. So ways to help your kids, but also ways to protect yourself. So ways to help our kids. So if your kids are young, we can think about buying an investment property. Remember that house that you have? Like, what if you had 2? This can be a really great strategy when your kids are smaller, and we can help you figure out how to do that using the equity in your home. So it's not as difficult as you think. We do have a whole webinar on that we can show you if you like, or we can chat through your options. Again, advice is free, so call us if you have questions or if this is something you'd like to chat about, because it can be a really good strategy when your kids are young to get a house or 2 extra that you could use to gift down payment in the future, sell and pay for their university. Maybe it becomes their first home. Maybe you sell it and they go buy a house with the equity in it. There's lots of different options that this opens up for you that are not currently there if you only have one house. Okay, you could gift them a down payment. So if they're a bit bigger and they're ready to go buy on their own, we could look at gifting a down payment. So if you qualify for it, we could look at reverse mortgages. The benefit of these is that there's actually no payments for you. The con is that it's going to be a slightly higher interest rate, but making no payments can sometimes get you the ability to gift equity in your home to your kids without having any monthly costs for you, right? So if it doesn't change your cash flow, then you don't have to move in order to give them that inheritance early. If you do not qualify for a reverse mortgage or that's not a desirable option for you, we could look at a refinance or a secured line of credit as another option. They are typically going to be lower rates than the reverse, but there's going to be payments. Sometimes we can set up a line of credit so that there's not actually payments, so that the monthly payment just goes on the line of credit and it increases over time. That is interest only. These things, they do have a negative impact for you in terms of if you are wanting to qualify for something in the future. So that's worth being aware of, that if you are taking out a refinance or adding a line of credit to your property, and then you want to go buy a cottage, now we have to calculate all this stuff inside the stress test. Okay, so the last option would be savings. So there's going to be no payments on giving them savings. The con is going to be the opportunity cost of that money. So especially right now, like what would your money make for you if you were to keep it invested, or if it's invested in something that is like an RSP, something that's secured? Is there going to be a tax event for you to pull this out? Something worth knowing is the First Home Savings Account. So this is a new account. It combines the features of an RSP and a TFSA. Contributions that go in there are tax deductible, just like the RSP. But when the funds are withdrawn, it's also not taxed like the TFSA. You can put up to $8,000 a year limit and up to $40,000 lifetime contribution. This is something you should be looking at doing for your kids, or encouraging them to do if they have jobs and they have the money to save for this. When you are helping them, you can also help them by being a cosigner or a guarantor. So a cosigner is where we use your income to be able to improve what your kid qualifies for on a mortgage. A guarantor is where we're using your credit to help your kids be able to qualify for a mortgage. Both of these items, you're kind of on the hook for the mortgage. So if they miss payments or they do something detrimental, that can still be held against you, but it is a way that you can help them get into a home. So ways to protect yourself. So things that you need to think about: picking the right mortgage product. If you are co-signing and you are unlikely to break the mortgage, at some point you can come off. They can do this on their own. You want to make sure that you're paying attention to penalties to break. They're going to be very important to you saving money. The other thing you need to be very careful of if you are co-signing is what other paperwork you need to have discussions about with your kids. Trust agreement would be one you would do with a lawyer. That would typically say that you own a certain percentage and they own a certain percentage. It can protect you from tax events, right? So it can protect you from CRA looking at that house as if it's a rental property for you and taxing you capital gains. It can also protect your kids that when you come up with title at some point, that they may not have to pay land transfer tax again. You need to look at wills. What does your will say and what does their will say? Is that property in there, and who goes, like, who does it go to, or what percentage you own, who does it go to? You don't want half of your kids' property tied up in an estate and going to their siblings if that was not your plan. The other thing you have to think about is a cohabitation agreement. If you help your kids buy a house and then they get a new spouse, they should have some sort of documentation in place to protect your investment and what you helped your kids purchase. Remember that house I showed you? So we actually paid $34,000 in capital gains because our accountant screwed up. Okay, made a mistake. It was our primary residence. It should have been tax exempt, right? But something like this can happen to you if you do not have those documents, these documents in place that I just outlined. So if you are co-signing, please pay attention to this slide. Trust agreement, will, and cohabitation agreement are things you need to talk to lawyers about before making a purchase with your kids. Right? This is learn from my mistakes instead of learning the hard way like I like to. Another discussion you need to have with your kids if you're going to assist them. So other questions that you need to chat about, right? Have the hard conversations on the way in so it's a lot smoother on the way out. So what if they get a new common law partner? If they are married, what if they separate or divorce? What if they damage the property? What if you pass away? What if they miss a mortgage payment and cannot afford the home? Or what if you have a limited time to help? You say, you know what, we'll help you right now, but we want to sell our home and buy, maybe you want to downsize or buy a house in Florida or a cottage or whatever you want to do in 5 years. What happens in that 5 years if they're not capable of taking on the property on their own? Other things you can help your kids when they are ready or when they're getting ready, teach them about credit. If you're not sure about credit, reach out to us. We're happy to give you some information, some guides. All our advice is free. Anything that we can do to help, we would like to. You should help them save for a down payment, encourage them to put money away for a down payment, look at RSPs or the first time savings home buyer plan that I outlined earlier. Um, Teach them about the costs of home ownership. We see a lot of first-time buyers who do not know that they have property taxes to pay and utilities to pay, and that how much a furnace costs when it breaks or how much a roof repair costs. Like, get them involved in the costs of home ownership so they understand what they're signing up for. And lastly, get them pre-approved properly, right? Don't let them be out shopping and not know what they can buy. That's a recipe for disaster. Make sure they're pre-approved properly by us or somebody else who is capable of doing so, with a bunch of different lenders. So they're not stuck if they buy something and just one lender doesn't like that property. Beware of the 3 Fs. So fraudsters, fake fees, and fake offers. So if something sounds too good to be true online, it probably is. We can provide you with all kinds of calculators and interest rates and what the major lenders are doing and what the policies say so that you can have a really good overview of everything. And lastly, what is the biggest outdated comment I hear from first-time buyers that they were told by their parents? Any guesses? I want them to avoid paying CMHC. So in 2016, how mortgages work, are priced, operate in the back end, it all changed. And what happened at that time was that insured mortgages, so less than 20% down, became more desirable for lenders to have. As a result, they priced them better. So yes, if you have less than 20% down, you will be paying either CMHC, Canada Guarantee, or Genworth Sagen now premiums. However, you will get lower interest rates. Having 20% down, you will not pay those default insurer fees, but you will have higher interest rates. So sometimes, depending on what it's offered, even if we have clients that have 20% down, there are times where they are farther ahead to put 19.9% down, pay a small amount of default insurance, and get the lower interest rate offered for those types of products. So it's not just a one size fits all anymore. There are different interest rates for different types of products, and you need to be aware of that. If you have any questions, feel free to book a call. You can reach out to our office, experts at laframboisemortgage.ca, or phone number 289-645-1568. We'd be happy to help. Let us know if you have any questions.